Gold just carved out its most violent reversal in modern trading history. We're talking about a $400 intraday swing that liquidated both sides of the market in less than 12 hours. Silver followed with a 22% range from low to high. This wasn't a correction. This was a total market reset. And if you're not paying attention to what's happening right now in the physical market versus the paper market, you're missing the most important divergence we've seen in decades. Let me give you the numbers first, then we'll break down what's actually happening. Gold touched $5,100 overnight before collapsing to $4,700, then reversing back to $4,950 by the close. That's a $400 range in one session. Silver hit $92, dropped to $71, bounced back to $85. The velocity of these moves is what matters. When you see this kind of price action, it's not retail panic. It's institutional deleveraging on a massive scale. Hedge funds, CTAs, momentum traders, all getting margin called simultaneously. The leverage unwind is what creates these violent swings, not fundamental changes in supply and demand. Now here's what's critical. While paper markets were in full panic mode, the physical market told a completely different story. Multiple dealers reported they couldn't source metal at any price. One major European refinery confirmed they're running 8 weeks behind on delivery commitments. Mints in the US, Canada, and Australia have either suspended sales or are only fulfilling pre-existing orders. This isn't a temporary supply chain issue. This is structural shortage meeting speculative liquidation. When paper crashes and physical disappears, that's not a bear market. That's a market dislocation that typically resolves much higher. Now let's talk about what triggered this. The narrative being pushed is that the new Treasury Secretary made comments suggesting fiscal discipline and dollar strength. Markets interpreted that as bearish for gold. But here's the problem with that narrative. Central banks didn't stop buying. China added another 18 tons to reserves this month. Russia bought 12 tons. Turkey bought 9 tons. These are official numbers. And these are the same central banks that have been accumulating for 34 consecutive months now. So if the fundamental driver of this bull market is central bank demand and currency debasement, why would a single comment from a Treasury Secretary change that multi-year trend? It doesn't. What changed was leverage got too high and the market needed to flush it out. Here's the technical picture. The 200-day moving average on gold sits at $4,200. We didn't even come close to testing it. The 50-day is at $4,600. We tagged it briefly and reversed hard. That's actually bullish structure. In a healthy bull market, you want to see dips bought aggressively at major moving averages. That's exactly what happened. Silver's 200-day is at $60. We didn't get anywhere near it. The 50-day is at $75. We went below it to $71, which was a 6% undershoot, then reversed within hours. That kind of quick reversal below a major moving average is called a bear trap. It's designed to shake out weak hands before the next leg higher. But let's look at the bearish case honestly, because that's what risk management requires. If gold breaks below $4,700 and holds under it for more than 2 days, the next support level is $4,400. That's a measured move target based on the size of the recent consolidation range. Silver breaking below $80 and staying there opens the door to a retest of $70 or even $65. Those are the levels where long-term buyers would likely step in aggressively, but getting there would require more forced liquidation. The dollar index is back above 104. That's a headwind for precious metals in the short term. The 10-year Treasury yield is sitting at 4.35%, which is elevated enough to create competition for gold as a safe haven. And equity markets are showing signs of stabilization. The S&P bounced 2% off its lows today. If risk appetite returns, some of the safe haven bid in gold could fade temporarily. Now here's where it gets interesting. Comex gold open interest dropped by 38,000 contracts in just 3 days. That's the largest 3-day decline since March 2023. Silver open interest fell by 11,000 contracts. When you see open interest collapse like this during a price decline, it means longs are being forced out. Once that process completes, there's no one left to sell. That's when bottoms form. It's not about calling the exact low. It's about recognizing when the forced selling exhausts itself. And based on the open interest data, we're very close to that point if we're not already there. Physical premiums tell you everything you need to know about real supply and demand. Right now, 1-ounce gold bars are trading at $65 over spot in Singapore. That's a 1.3% premium, which is double the normal level. Silver Eagles are at $8 over spot. That's a 9.4% premium. In Europe, premiums on silver bars are running 12% to 15% over spot. These premiums don't expand like this unless physical demand is overwhelming available supply. Paper can trade wherever it wants in the short term. But when physical buyers are willing to pay 10% to 15% over spot just to secure metal, that tells you the real market clearing price is higher than what the futures market is showing. Let's talk about what happened in Shanghai, because this is critical. Shanghai gold premium hit $45 per ounce at one point during the sell-off. That means Chinese buyers were paying $45 more than London spot just to get physical delivery. The normal premium is $10 to $15. When it spikes to $45, that's panic buying in the physical market while the paper market is selling off. This is the exact opposite of what should happen in a genuine bear market. In a real bear market, physical premiums collapse because nobody wants the metal. What we're seeing is physical premiums expanding during a paper market sell-off. That's a bull market correction, not a bear market. Industrial demand for silver remains extremely strong. Solar panel production is still running at record levels globally. China installed 320 gigawatts of solar capacity last year. Each gigawatt requires approximately 80 tons of silver. You do the math, that's 25,600 tons of silver going into solar annually just from China. Global mine supply of silver is around 26,000 tons per year. So just solar demand from one country is consuming nearly all of global mine production. Where's the silver coming from for electronics, batteries, medical applications, and investment demand? It's coming from above-ground inventories, and those inventories are now at 15-year lows according to the Silver Institute. Now let's address the elephant in the room. What if this is the top? What if gold peaked at $5,100 and we're now in a multi-month or multi-year bear market? It's possible. Markets don't go up in straight lines forever. But here's what would need to happen for that scenario to play out. First, central banks would need to stop buying or start selling. There's no evidence of that. Second, currency debasement would need to reverse. Governments would need to balance budgets and reduce debt. There's no evidence of that either. Third, industrial demand for silver would need to collapse. Solar installation would need to stop. Electric vehicle production would need to crater. 5G infrastructure build-out would need to halt. None of that is happening. The debt dynamics alone make a sustained bear market in gold unlikely. U.S. federal debt is $38 trillion and growing by $2 trillion per year. That's $5.5 billion per day in new debt. Interest expense on that debt is now over $1 trillion annually. That's more than the defense budget. When your interest expense exceeds your defense budget, you've lost control of your fiscal situation. The only way out is inflation or default. Both scenarios are massively bullish for gold. So unless you believe the U.S. government is going to suddenly achieve fiscal discipline and balance the budget, the long-term trajectory for gold is higher. The question is just how much volatility we endure along the way. Bitcoin dropping below $75,000 is significant. It broke below its 200-day moving average for the first time since the bull market started. Crypto and precious metals have been trading in tandem for the past year. When one sells off, the other usually follows. But there's a key difference. Crypto is a risk asset. It trades like tech stocks. When risk appetite fades, crypto gets sold. Gold and silver are different. They're both risk assets during the momentum phase of a bull run. But they're also safe havens during crisis. So if we're entering a period of systemic stress, crypto could continue lower while metals reverse higher. We're watching Bitcoin's 200-week moving average at $68,000. If it breaks below that, the crypto bull market is in serious trouble. But that might actually be bullish for metals, as capital rotates from digital assets into physical assets. Geopolitical risk is escalating rapidly. Reports of direct military conflict between major powers are circulating. Trade wars are intensifying. Diplomatic relations are deteriorating. Historically, these conditions are bullish for gold, but the initial reaction to geopolitical shock is often risk-off selling across all assets. Cash is king when uncertainty spikes. Only after the dust settles does the safe haven bid kick in. So if geopolitical tensions worsen from here, we could see another leg down in the short term before the sustained rally resumes. That's the nature of crisis-driven markets. Volatility increases, time frames compress, and emotional trading dominates. Here's what I'm watching for confirmation of the next move. Gold needs to reclaim $5,000 and hold above it for at least 3 consecutive days. That would confirm the bull market is intact, and we're just experiencing a correction within an uptrend. If gold breaks below $4,700 and stays there, we're likely heading to $4,400 or lower. Silver needs to reclaim $90 and hold. If it does, the target is $100 to $110 over the next few weeks. If silver breaks $80 and can't recover, we're probably going back to test $70 or $65. Those are the levels that matter. Everything in between is noise. The gold to silver ratio hit 58 during the sell-off. That's the lowest it's been since 2020. Historically, when the ratio gets below 60, it means silver is outperforming gold significantly. That ratio has room to compress further to 50 or even 45 if silver continues to catch a bid from industrial demand and investment flows. But if risk appetite collapses and we enter a deflationary scare, that ratio could bounce back to 70 or higher, as silver gets sold more aggressively than gold. The ratio is a sentiment indicator, more than anything. Low ratio means risk on, high ratio means risk off. Physical silver inventories at Comex are at 282 million ounces. That sounds like a lot until you realize that annual investment demand alone is around 200 million ounces. So Comex has about 16 months of investment demand sitting in registered inventory. But here's the catch. Not all of that metal is available for delivery. Much of it is already allocated to existing contracts or held by ETFs. The amount of truly unallocated silver available for immediate delivery is estimated at less than 50 million ounces. That's about 10 weeks of global investment demand. If physical buying accelerates, Comex could face a delivery crisis within months. Let's talk about the ETF flows because they matter. Gold ETFs saw outflows of $1.2 billion last week. That's significant, but not catastrophic. During the 2013 bear market, gold ETFs saw $60 billion in outflows over 18 months. We're nowhere near that level of liquidation. Silver ETFs actually saw inflows of $87 million last week, despite the price decline. That's notable. It means retail and institutional buyers are still accumulating physical silver even as the paper market sells off. When ETF flows diverge from price action, it usually means the price action is driven by derivatives and leverage rather than real physical supply and demand. Mining costs provide a floor for prices. The all-in sustaining cost for gold production is estimated at $1,400 per ounce. We're trading at $4,950. That's a massive margin for producers. For silver, the all-in sustaining cost is around $20 per ounce. We're at $85. Producers are printing money at these levels. But here's the issue. It takes 7 to 10 years to bring a new mine online. So even if prices stay elevated, supply can't respond quickly. That creates a structural deficit that can only be resolved through higher prices or demand destruction. And with industrial demand for silver being relatively inelastic, price is going to have to do most of the work. Currency devaluation is accelerating globally. The Japanese yen is back near 155 against the dollar, despite intervention from the Bank of Japan. The euro is struggling to hold 103. Emerging market currencies are under pressure across the board. When currencies weaken, the purchasing power of citizens declines. That drives demand for hard assets like gold and silver as a store of value. This is already happening in Turkey, Argentina, and parts of Southeast Asia. If currency stress spreads to developed markets, which is likely given the debt levels, gold demand could surge beyond anything we've seen historically. But one final point in volatility. Gold moved $400 in a day. Silver moved $21. These are massive percentage moves. If you're using leverage or trading options, moves like this can wipe out accounts instantly. Even if you're right about the long-term direction, you can still get stopped out or margin called during short-term volatility. This is why position sizing matters more than anything. If you're holding physical metal with no leverage, you can ride out the volatility. If you're trading with 10 times leverage, a 10% move against you is a total loss. Know your risk, manage your position size, and never put more capital at risk than you can afford to lose completely. So where does that leave us right now? The paper market is showing a correction within a bull trend. The physical market is showing scarcity and rising premiums. Central banks are still buying. Industrial demand remains strong. Debt levels are accelerating. Currency debasement is ongoing. Geopolitical risk is elevated. Those are all bullish factors. But short-term technicals are mixed. Leverage is getting flushed and sentiment is fragile. The setup is for more volatility before clarity emerges. If you're a long-term holder, this is noise. If you're a trader, every level matters, and risk management is everything. Do your own research, understand the risks, and never invest based on emotion or hype.